Before we jump into the show this week, I wanted to remind you, if this is your first time listening, you can go to financialsymmetry.com and you won't want to miss the blog subscribe email that you could get weekly. It's the bottom of our page. You can sign up. Only one email. It keeps you more up to date of the articles, podcasts, videos that we're doing, answering actual client questions. And then you'll also get one monthly email that has the best things we read that month and other extra inside info. So don't miss that, and I look forward to having you on each episode every 2 weeks here. Now, let's get on with this week's webinar. Welcome back to the Financial Symmetry Show. I'm your host, Chad Smith, here again this week with Mike Eklund. And news from the markets is dark, right? It's the darkest it's been since 2020, or maybe those that remember in 2009. I mean, you have most stocks in a bear market at this point, rising interest rates, which has impacted bonds, and they're having one of their worst years ever to this point, at least in the year. And it's a pretty short period so far this year. And inflation's at a 40-year high. So it makes it hard to not wonder what changes you should make to relieve some of your worries. So today, Mike, we're going to highlight where we are from a historical perspective, and from a market's perspective, and then what's happened in similar situations. We'll walk through a couple of examples and graphs there. And if you're listening to the podcast, you can refer back to YouTube for this. And then towards the end, we're going to talk about how you can have a retirement plan that provides more comfort through an investment roller coaster.
Thanks, Chad. It's great to be back, and it's interesting. Everything you kind of started with there, it kind of is why not to invest, right? Because all these the inflation, we have higher interest rates, the stock market is down. I mean, I was looking back, and we did a similar type podcast for this back in February and March of 2020, and it's been a couple of years since we had this topic, but as expected, the markets don't go in a straight line, so it was time for a correction or bear market, whatever you want to call it. So we get to talk again about what to do. And so we have a few things we want to chat about. And like, as Chad mentioned, for those listening to the podcast, the YouTube video will also have the slides you can kind of follow along with as well. Not required, but might be helpful to some of the things we reference. But talk about the current situation, what we're seeing in the markets today, a little bit about market history. Is this time different? And this is the question we always get. If it's a pandemic, if it's an election where the president you want to win didn't win, if it's global financial crisis, there was always a question, is this different? And then kind of the big question for many folks today is, what should I do? And then finally we end with kind of, questions, next steps. So yeah, so it's a definitely interesting time. And this first slide we'll go through for those listening is slide 3, looking at the current market. And then, through, I think yesterday, which was, I believe May 9th of 2022, the market was down kind of in the 16 or 17% so far this year. And so we are looking at a slide from JP Morgan that shows since 1980, on average, the market declines sometime during the year by about 14%. If we had the same slide back to 1926, I think the average is like 16%. So far this year, we're kind of right along average. The reality is, if you take away COVID of March of 2020, the last 4 or 5 years, the market have not been that volatile. So people are used to kind of seeing their statements and their returns go up. And so this is the first time in a while we've seen a bumpy road. And what we'll talk about here in a second, it's not only a bumpy road in stocks, it's been a bumpy road in bonds too, which really for the last 20 years have kind of come to the rescue when stocks have not done well.
Yeah, I've always loved this slide because there's a lot of red, of course, on the dots that show that lowest point in the year, from peak to trough that stocks will fall. But there's a lot of gray above the line there in the positive territory for a long period of time. So that can give you confidence in knowing that these declines have been temporary up to this point.
Yeah, exactly. I mean, 75% of years are positive, but every year has a decline. The market's not always up, and on average, those declines range from kind of 14 to 15%. Sometimes are greater, like we saw in 2008, or saw a little bit in 2020, and sometimes they're less, what we saw last year. But the other big news this year, besides the stock market, is really interest rates. So the Federal Reserve has raised rates a couple times already this year, which is kind of news for the last few years as well. But we've also seen the Treasury yield. The Treasury yield is good because this takes a look at what they expect to happen in the future. And so those rates so far this year have increased anywhere from 1 to 2, almost 3%, depending on where you're looking on the yield curve. And so for those, for example, maybe looking at for a mortgage now, they may have seen those rates have gone up from what was during the lows in the mid 2s for a 30-year fixed mortgage to now, last I heard, was on 5.5% for 30. I mean, maybe some can get lower, but it's a large increase that impacts your ability to buy houses. It impacts the ability for companies to borrow. But on the positive side, for those that invest in bonds, it does provide a higher return because you're getting paid more today for owning those bonds than you did, 3 to 4 months ago. So this slide looks at the blue line, looks at the what's called the yield curve, what you get paid for owning a bond that matures in 1, 5, 10, 30 years today versus what you got paid December 31st of 2021. And so, for example, the 10-year treasury, which a lot of people focus on a lot, was 1.52% in December 2021, and now it's 2.89%. And so how it works is when rates go up, bond prices go down. And so that is the primary reason why you're probably seeing negative returns so far this year in your bond portfolio.
Yeah, and one of the things we talk about here, of course, is the longer term perspective when you're investing, right? The short term money you keep safe on the safer side of things, but for longer term money that you're not going to use over the next 5 to 7 years, you can invest in riskier options. And bonds have moved a little more to the forefront in the first 4 months of this year because there's some negative returns, and people haven't seen that in a while for their bond funds. But that doesn't mean it's going to sustain over the next 5 years. So that's one of the points that you can remember on bond investments.
Yeah, I mean, your bond investments are a much better investment today than they were 4 months ago. I think the summary is to take away from that. And I think I also will say, just in regards to stocks and bonds, they don't go in a straight line. The fee you pay for those higher returns is this volatility. Yes, it may feel comfortable to sit in cash, but the risk in cash is, with inflation, expected to average 2.5% to 3%, but obviously much higher listings lately, is that cash loses money every day. And so really to keep up with inflation, you have to invest in either owning companies or lending to them. And as a result of that investment, you have to deal with these short-term, historically temporary declines.
Yep. So moving on to discuss a little bit of the market history, I think, to give that longer term perspective.
Yeah, no, that's great. This is the next slide. Just looking, and a lot of people probably have looked at one of these, but it kind of looks at the stock market results from 1926 through 2020. It says if you had $1 invested in 1926, today, if you invested in small cap stocks at that time, it would have been worth about 32,817. In large company stocks, about 10,937. Where did inflation go from that, almost 100 years? From $1 to $16, $15, $16. So what that shows is that being an owner, owning businesses or stocks or companies, have provided annual returns 3 times the rate of inflation. So we feel over the long term, owning those businesses is a great way to hedge against potential rising inflation. The second thing I think to take away from this picture is the owners of businesses, which is stocks, get a substantially higher return than lenders, which is either bonds or cash, because those owners take on more risk. And so that's really the big 2 key takeaways I would remind folks from this graph on page 3 or page 5.
And another point on this is if you're a younger person, not yet retired, but moving towards retirement, you are investing continuously, likely in a 401k, and getting lower prices. And that's a hard thing to remember when you're seeing red on the news every day or on your phone. It can dent that confidence that are you still doing the right thing? But many people enjoy a deal when they're getting things on sale. And that's what is happening in the stock market whenever you're in that situation.
Exactly.
And what enables that long-term return from that chart, if you go back and look at that chart. So,
yeah, it's hard to imagine for younger folks. The best thing that can happen is the stock market can decline for a while because you're buying at cheaper prices. And as Chad mentioned, for those retired, maybe pulling out money out of their portfolio, just making sure you have that money set aside through the more conservative bond approach to help pay for those expenses in the short term. This is a similar slide that we had on page 2, a little bit more longer time period, going back from 1928 to 2019, but just showing that every year there is a decline. Depending on the time period you go from, it averages between 14 to 16%. But it's important to note that once every 6 years, we typically have a bear market, which is a decline of about 30%. Now, is this current decline going to turn into a bear market that goes down 30%? I have no idea. I don't have a crystal ball. It could not. We could recover from here. We could go back down further. I'm not sure. But all I know is that this is normal, and that historically all declines have been temporary, unless you make it permanent through selling.
Yeah, that panic selling can be that big mistake we often talk about for the long term, because it's very difficult to determine when you get back in. And this chart, of course, speaks to that idea you said, where you're going to have a higher percentage of years in the positive.
Yeah, as you mentioned, Chad, once again, like 3/4 of the years are up. So we've had actually the last 3 years are up. So maybe this is the down year. I don't know. But 75% of the time, the stock market has a positive return. 25% of the time is negative. I think the key takeaway from this slide, which I believe is slide 8 for those listening along, is the difference, the range of the returns, from, negative 40% in 1931 to 57% in 1933. But it's the stock market very rarely, if ever, returns kind of its historical average, 8 to 10%. Typically, the returns are much wider, kind of on the extremes, a negative 10% decline or a 25% increase, which we saw somewhat similar to last year. So it's important to note that it's there's no such thing as an average. There is a long-term average, but on a yearly basis, there can be quite a bit of volatility.
Yeah, you tend to get bigger days too, right? Closer to each other when you're in those extreme periods, like positive 3% or negative 3% drops. In the pandemic, you saw much bigger moves in a day, but that can be jarring to see.
Exactly. Yeah. I mean, it's we'll get to this a little bit later, but obviously the media is there to sell clicks, not to help you reach your financial goals. So just keep that in mind, that their job is to scare you and scare everyone, to get you more interested to watch or listen or read what they're writing. So, but that is maybe not in the best interest to your long-term financial health. But the next slide here, which was, I believe, slide 9, this just looks at, historically, I think we've had 17 or 18 bear markets. I don't know the exact number, but it's been quite a few since 1926. So it's normal. Some of the declines are much worse, such as we saw in 2008 with about a 51% decline, a 57% all-in decline. Some are shorter, what we saw in the 60s there with about a 22% decline. But it is something that, if you are a 60-year-old and let's say you live another 30 years, there's a good chance you are going to see 5 to 6 more bear markets. That is normal. If you're 30 years old, you're going to see, 10 to 15 bear markets. So I guess the takeaway is this is part of the rules of investing. And, as once again, it's expected. And the key thing is to have a plan in place, which we'll talk about later. This is probably one of my personal favorite slides. And I think this is how I try to get folks comfortable, for those listening to the podcast, really thinking about how the risk of those equities decline over time. And if those looking on the screen, what it shows is the percentage of rolling periods in the S&P 500 from 1926 to 2020 that have had positive returns. And so on a daily basis, the stock market is positive about 50% of the time and about 50% negative. So really, it's almost a coin flip on a daily basis. We've talked about on a 1-year time period, about 3/4 of the time it's positive and about 1/4 of the time it's negative. But you get out to about 10 years and you're almost 95% positive. 95% of the periods from 1926 to 2020, you've had positive results. You got 15 years, and I think it's almost 100%. So what the takeaway here is, and for those listening as well, is the longer your time period, the less the risk there is in the stock market, which is, once again, as mentioned earlier, it's important to create a portfolio, which we do for our clients here at Financial Symmetry. If the money is needed in the short term, we say short term, I'd say more 5 to 7 years, it should not be in the stock market, we don't believe. But money not needed in the short term, we believe should be invested for long-term growth, because your short-term risk is market declines, but your long-term risk is really purchasing power. Your money not keeping up with inflation. We've been hearing a lot about that in the news lately, but keeping money in the cash or very short-term high-quality bonds will actually, the value will decline over time, because as inflation increases, the value of those dollars will be less.
Yeah, that short-term turbulence, right, that you experience sometimes on flights. You use a lot of flight examples there, Mike, yes, with your piloting background. You don't normally try to tell the pilot we need to stop the plane if you're going through some turbulence, right? But you get to that long-term, your destination, and take many flights over your lifetime. And it's normal, right? Bear markets are normal. They're painful, but they're much quicker. And that's what I like about that previous number 9 slide and this number 10 here, if you're going back to check it out if you're listening to the podcast. So we get this question nearly every time there's a decline, right? Because the reasons can be a little different each time. Sometimes they're similar to something in the past, and you never know what the actual reason is, but still we get this question: is this time different? Should I be doing something different?
I said the last slide was my favorite. It's hard to say this is not my favorite too, just because there's just so many good kind of takeaways. And it's a common question of, there's always a reason not to invest. If it's, not the current, war in Ukraine, inflation, recent presidential election, the pandemic, you can name all the different lists of reasons. Brexit, on this list, we have other things like Y2K. There's always a reason not to invest, but $1 invested in the world stock market in 1970 with dividends reinvested was $80 at the end of 2020. And given that 2021 was a good year, that number likely is higher from there. But it just shows you that, the stock market, looks forward. So if we're talking about it today, it's probably already priced into the stock market. And, you use the plane, you could also use the roller coaster analogy. If you're on a roller coaster, it's important to stay in your seat. If you stay in your seat, you'll be well rewarded for investing in, well, I'd say companies, also called stocks, over the long term. It's just, you have to deal that fee is those short-term market declines. And there are many of them, and there's always reasons not to invest. There's always reasons why this time is different. But I think rational companies that are seeking profit will do well over the long term.
Yeah, the key word there is discipline, right? Markets reward discipline. I equate it sometimes knowing we know what we need to do on the fitness side of things. We know how we should eat. We know that we need to exercise, but it's really hard to implement for most of us. Investing is not all that different. It's very difficult to sit and stick with a strategy through the tough times that make you feel nervous and keep that discipline. That brings us to our next strategy here, right? And let's talk through some of these things. What should you do in these situations when you're feeling these feelings, if you're not listening to us?
Exactly. I mean, if you're the do-yourselfer, you're driving the car, walking the dog. Okay, now here's the punchline. Okay, I'm nervous. I'm not sure what to do with my portfolio. What are my options? So in these type of markets, you really think you have four options. One is move to cash, just to kind of say, hey, I can't take anymore. I want to get out of the market. Second is what's called rebalance, and that might be, buy stocks, and how much is part of your strategy. The third is, we've talked a little bit on the previous podcast, called tax loss harvesting. Take advantage of these market declines to save on future taxes. And the fourth one is really just stay invested, stay the course. Don't really do anything. And so, as moving forward on this slide, which is slide 15, really talking about investor behavior. And for those listening on the podcast, it's just how people feel based on how their investments are doing. What we typically see is when the markets do well, they feel really good. They're very overconfident on their investing ability. We've probably seen a lot of that in the last few years. I feel like they're maybe open an account from a certain brokerage firm that you get excitement when you buy and sell stocks. But then when things start going poorly, they start wondering, okay, well, maybe I don't know what I'm doing, but this is just temporary. I'm going to, things will turn around next week or next month. And then things continue not to do well. And then they kind of say, you know what, the markets aren't for me. I need to invest in something else, something else that will provide a better return, because the stock market is a casino. It's rigged. And then there's a point where the market kind of hits a bottom, and then the whole process starts again. And so it's important to understand kind of where you sit on that spectrum. And if you don't have, I've always said, your investment behavior is really the primary determinant of your returns more than the investments themselves. So if you don't feel like you have the behavior to stay the course, this is where definitely a qualified professional advisor would help you along in the process.
Yeah, it's interesting looking back through some of our old posts. We have 71 pages of blog posts. I mean, it's over 500 posts on our website. The one from 2008, November of 2008, that we wrote there, we talked through a couple of different feelings that you could be forced out of the market, you could be scared out, you could be faked out, or you just can be worn out a lot of times, and that's what really captures this investor behavior. At some point in the spectrum, you're going to feel one or all of those feelings, and having that discipline to stick through it can be a major benefit down the road, right? And part of that is following this strategy here on our next slide, 16.
Yeah, and I think this is the biggest challenge, especially in today's environment, probably more than 10 or 20 or 50 years ago. It's looking behind, look beyond the headlines. This is, the TV, podcasts, radio, blog posts. You hear things like sell stocks now, looming recession, markets hit, rocket bottom, things that kind of make you think like, okay, inflation is never going to end. They tend to stir anxiety about the future, or they'll maybe make you chase or tempt you to chase investment fads, which might not be in your best interest. And they can really challenge your investment discipline. Investing, we've said it before in this podcast, I'm going to say it again, it really should be boring. The challenge is a lot of people like to make it exciting, and you've seen a lot of that the last few years, and that create risks and potentially creates, big declines or long-term results that are not helping you reach your goals, like when you can stop working or, pay for your child's college or other goals you may have. So, consider when you are unsettled, consider your investment strategy and your perspective. And if you don't have a good, well thought out strategy, maybe think about someone that does, like, financial Symmetry. We've been doing this over 20 years. We have a pretty thorough process, so there's, something we can fall back on where many folks, just kind of listen to the news or a friend or a relative to make decisions.
Yeah, it's nice to have a guide, somebody, a co-pilot, if you will, if I stick with my airline examples to help you through this, because living in an echo chamber can be quite costly in the long run. And then that brings us to this next idea that, the media, if you listen enough, could cause you to think that you might be able to do this successfully. And that's time in the market.
Well, can you do that, Chad? Can't you just go to cash like our first choice? And then when the market hits the bottom, we buy? That seems like the best choice, right?
Just like I can go work out 5 days a week, every week, and eat as healthy as I possibly can all the time.
Yeah, I mean, that's the challenge. I think the one that everyone kind of sits back on, like, oh, I would have known to buy stocks in March of 2020 or March of 2008. It's always like, hey, when things are bad, let's just go to cash. We know it's going to get worse. And then when things when things look like they're going to get better, let's get back in. But the problem is, you might miss those opportunities. You may miss those really good days when things do turn. And then you have to make the decision, now, do I want to buy at higher prices? Or do I want to stay on the sidelines and wait for hope for maybe another decline? Because the stress of being out of the market can be as stressful as being in it. And so, as noted on the graph here, we have on page 17, missing those best days can have a big time impact your long-term financial results.
Oh yes, we've tackled this one, I think, in another podcast we did on retirement regrets, and it's that idea of checking your portfolio too often.
Yes,
can create a lot of that emotional stress and make you think you need to do something. So, but it can also help to have a strategy around regular reviews, right? And tactics that you can use to adjust on the fly.
Yeah, and so this is great. So option one was move to cash. We talked about option two was rebalance. And so this slide, we're looking at slide 18 here, just talks about a little bit more about our approach, but you might have your own if you do on your own, but rebalancing, or what rebalancing is, buying stocks, maybe selling bonds, or investing cash you have on the sidelines you've been waiting to invest back to whatever your target stock allocation is. It could be 70%, 80%, 90% of your portfolio on stocks. Taking this opportunity of market declines to buy low and sell high, or effectively if things go up, you would sell high, but this is opportunity to buy low, which would be hopefully higher future returns. And so this is, that's a good reminder to have a process in place. We have a process with our internal system to tell us when to buy and sell, but if you're doing it on your own, to have something to decide there as well. This next, moving forward, talks a little bit about, well, I want to, I'm nervous, I don't want to buy when the market is down. Historically, that's been a good time to buy. The returns after market declines, either a 10 or 20 or 30% decline, has been very strong. After, for example, a 20% decline, the next 3 years, on average, the market's been up about 36%. The next 5 years, the market's been up about 72%. So purchasing during market declines has typically been a good thing. I've always kind of said, if it's really hard to buy, it's usually a good investment. I can remember, buying stocks in March of 2008 and March of 2020. It wasn't easy, but the end result was very good.
Yeah, and one of the best ways to test this is through a financial plan. You can test that robustness, right? We were talking about that recently of your plan. When you look back and see how many scenarios are you successful in and still having money at your expiration date on whatever that is down the road, right? And the goal is to not have money at risk that you need in the short run. And then you can maximize the amount of return you can get with the rest of your portfolio by putting that money at risk and not having to worry about it. If you can look at your plan and know you're going to be okay in the long run.
Yeah, the financial plan provides a significant amount of peace of mind. So I think it's a great time to work with your planner just to make sure you're still on track, even after the market recent decline. So third option, we just finished tax season, tax loss harvesting. So this is a way to take advantage of this decline. I know we've been doing a lot here recently, helping our clients out, help with the 2022 taxes. We did a former podcast on this. We'll include that in our show notes, but it's an opportunity to sell maybe a holding that has not made money and then reinvest those proceeds in a different investment, but maybe still could be in stocks. There's some rules around your team can talk about kind of what type of investment you have to invest in. It can't be the same investment, but be able to realize that loss, stay invested long-term, but then also kind of save you on taxes in that tax year.
Yeah, this is a silver lining when you're experiencing some losses, and just going to add a little bit of extra feeling that you're doing something right that will benefit you when you're experiencing gains down the road.
So, and then the final thing, as we talked about, is just stay invested. Hey, I'm just going to stay the course. I'm not going to rebalance. I'm not going to tax. I don't have a situation where I want to tax loss harvest. I'm not going to go to cash, but inflation's so high, I'm not sure what I'm going to do. There's no choices here. But what those listening, this is slide 21, looks at historical returns when inflation is above average for different types of investments, including cash, bonds, the stock market, and then different areas of the stock market as well from 1927 to 2020. The punchline is, cash historically has been a negative result. It was also called T-bills during high inflation periods because typically the Fed doesn't keep up fast enough with inflation. The best investment has been with something called small cap value companies. And so Grace Cavantes and I talked a little bit further about what that was on our first quarter market webinar, but these are companies that are smaller and cheaper and historically have exceeded real returns, which is after inflation, by about 12% a year. So very strong during periods when you had high inflation. Just the general equity market or stock market has exceeded inflation by about 4.9% per year. So once again, we do believe owning businesses or stocks is the best defense in the long term against inflation. So if you are just going to stay the course, keep that in mind. Don't make material changes to your overall equity portfolio.
Yeah, and we normally end our episodes here with this idea of a progress principle that you can have. There's some power in a small win if you can actually take something from the episode and implement it in your life. And for this episode, obviously, it would be, if you don't have one already and you're not working with a financial advisor, create a financial plan, because your financial plan is invaluable in moments like this, because it can provide a peace of mind aspect that can get you through the tough periods to have that discipline. And on the other side, you can look back and feel, take that deep breath, because you know that you were able to stick through it and get the higher return that you were trying to reach, that you tried to achieve in your financial plan.
No, I agree. I mean, that is the roadmap we talked about, but being a former pilot, that is my flight plan, that financial plan. It kind of keeps you on track to make sure no matter what bumps and what turbulence you experience, market declines, job changes, kids going to college, et cetera, it keeps you on track. But I think that would be a great takeaway. And in addition, this is the slide we have here to talk a little bit more about financial symmetry and who we are. We have a big team, as noticed here, including many certified financial planners, as well as CPAs as well.
Yeah, tax planning is a big part of our business, to think about ways that we can find opportunities there for you. So that's it's a nice aspect that adds to the investment piece of what we've been talking about today, and finding that discipline that you have with your investment plan. But within the context of the financial plan, you got tax planning, estate planning, cash flow planning, many other areas, risk planning as well, that you need to have a way to regularly review. And that it's nice to have multiple expertise to rely upon here. And then, of course, to follow up here, if you have other questions about this, we put a picture on our last slide here of our website. There's a magnifying glass in the upper right-hand corner, and you can search any topic there, and it'll pull up all the articles or pages that we've referenced that topic. Of course, we have over 160 podcasts. We've got over 100 YouTube different videos now too. And then you can always reach out to us. There's a contact us box on our website there. Send us an email. And if you don't want to miss the next episode, you can subscribe on YouTube if you're watching us there, or subscribe in your podcast app. And, happy to be in your inbox in your podcast listing app for the next 2 weeks. We put this out every 2 weeks in different formats and different topics. So Mike, thanks for putting this together, and then we'll talk to everybody in 2 weeks.